I find that a lot of investors spend time trying to, they spend a lot of time on the price of a particular stock, and they look at valuation parameters like P, etc. How do you view valuations?
I think P is one of the most deficient ways of judging value or trying to predict price. And unfortunately, it is so popular that it is almost assumed a monstrous kind of a proportion of certification from the market behavior, or rather behavior of the market participants. P can hardly be any meaningful measurement of a value. Price earning multiple essentially is price today and an earnings over a short period of time, maybe a year or two or whatever. While value of a business can't be about 1 or 2 years of earnings, but a lifetime of the value creation. Secondly, price earning multiple by definition seeks to just correlate price today with some earnings number, but it doesn't take into account the time value of money. And valuation parameter without time value of money is a complete financial illiteracy. Thirdly, price itself is influenced by fundamentals. Price at a point of time is a combination of fundamentals plus the noise or sentiments at that point of time. Therefore, price itself is influenced by externality, while the value of business is all about intrinsic to that business, and therefore there is a complete intellectual contradiction in terms of using an external parameter to judge the internality of a business. So there is a bit of a confusion. I think value of a business is nothing but what it is worth as far as tomorrow's profits are concerned, or cash flows, and those cash flows can't be for a short period over the economic life of the business. Those cash flows, since they occur over different periods of time, they need an appropriate discount to reflect the appropriate time value of money or the internal rate of return that you expect. And constant effort thereafter is to keep evaluating whether the assumptions that went behind judging the value remain valid, whether the size of opportunity judgment remains valid, management capability, and therefore the assumed growth rate. More importantly, the quality of the growth rate, therefore the cash flows, and not just the gross cash flows but the incremental cash flows. Also, given the constantly shifting sand in terms of the businesses and the disruptions, what is the relevant economic life of the business and how far it is valid. These issues constantly need a reflection, and therefore the value will be revised based on that. But value certainly cannot be simplistic factor like price earning multiple.
Right. So it's more important to know the value of the business rather than the price, and it cannot be looked at from a simple lens of 1 or 2 financial parameters.
Oh, without any doubt, I think the price is a servant, value is a master. But unfortunately, the way participants often behave, we tend to value the price rather than pricing the value, and therefore there is kind of a confusion which comes about. Ultimately, the beauty is that even if however violent is the difference between price and value at a point of time, over a period of time, like a magic wand, the two come together. And therefore, if you are a patient investor, you have judged the value well, you bought it at a discount to the value, you can be rest assured in a confidence that eventually price will equal the value. You will bridge that gap between price and value, or the margin of safety, as a one-time extra, plus the underlying growth which will give you the compounding kind of returns. So the value only can really be the determinant of the long-term outcome.